So hello and good morning. I welcome you to the morning meeting today on Thursday, the 4th of January 2018. This is Jens Lett speaking, and I'm exclusively presenting this format to you here for JFD Brokers as their global head of research and education. We're going to have a look at the market opening and also especially at the DAX here and the developments after the DAX long or short in the morning. You may remember that I said I'm a little skeptical whether I really want to be long here, even though so far it looks good. I mean, the trade itself, if you entered the market at 13,075 points as suggested based on the open range, well, you're well ahead in this trade, 20 points around, and you were already ahead something like 45 points. You were capable of moving the stop to break even, but so far it doesn't look that promising. So you can see here the market pushed towards 13,121 in the high, here around the highs. So the entry is here, which is equaling 46 points. If you're working with an initial stop here at 13,025, 26, that means you're working with a stop of 49 points, 48, 49 points. And so one trading rule I live by, if I have 1 R in my P&L, well, I move the stop, I trail it to break even. And that happened right now. And so you're placing your stop is somewhere here around this breakout level. But so far it doesn't look that promising that the market continues to rise here. So as I already said, it's difficult to see the market moving with such dynamic and momentum on the upside, especially if it extended its gains and built a quite huge gap here between the price and the exponential moving average 50. So far, it's a very nice indicator, not just a trend filter, which I use here to identify my advantage when trading the open range, and when we're trading above the 50 exponential moving average, well, I'm trading the long side. If we're trading below that, I'm going short. But it's also interesting to see that this is a moving average, which not hopefully, but most of the time, or right now at least, is working as a good indicator for a fair price, respectively a support resistance line, which is accepted from the market, happening several times, by the way. So you can spot this several times here. For example, also here, that was the 28th of December, for example, and you can go back here, especially in trending markets. That's not so well in range bound markets, but in trending markets, and you can see this over a quite extended period of time that this exponential moving average 50 on a 5-minute time frame works really well. And I said, well, there are two possibilities. One is that the market pulls back towards the 50 exponential moving average, or that the market stabilizes at an elevated level and the exponential moving average then comes nearer to the price. And right now, the second is happening here, and even though you can see that the market has some trouble to gain further momentum on the upside, that has also something to do probably with the fact that we're quite extended here based on the hourly chart. As you can see, on Tuesday we pushed below 12,800 points and now are bought back very aggressively, something like 350 points within nearly, in fact, 1.5 to 2 trading days here. And so that looks also a little extended. And as you can see here, by the way, is that everything below 13,130, 150 points, my personal opinion at least, is considered bearish. And we should be really careful here to be too optimistic. And this is also true because the euro right here can stabilize above and right now pushes higher again against the level around 120. And with disappointing data probably today at 1:15 p.m. GMT around the ADP data set, there's a good chance that probably the US dollar, if the data disappoints then, and this is completely the opposite of what happened yesterday with the ISM manufacturing, which came in above expectation and resulted in the USD to gain back some of the losses of the last weeks here and pushing Euro USD to as low as nearly 120. That then there's a good chance that we push up to 121, and with a stronger euro, which is currently negatively correlated to the DAX, usually the DAX has a chance to pull back here. All this combined leads me to come to the conclusion that I say probably it's not so attractive from a risk reward perspective to be aggressively long the DAX here. So my favorite scenario, in fact, in the DAX is to wait for a pullback, which is probably bringing us down towards here 13,020 to 13,020 points on the downside. But let's just see. So far, I still step back. I didn't formulate a clear and clean trading setup in the morning. I only said, well, trading the open range, purely from a technical standpoint, happens in the moment we're breaking above 13,075 points, placing the stop here. So 1 R is earned, so we can trail the stop to break even. And now let's see. Even though I think that chances are high that the market will take out this trade rather sooner or later here, and that there's another good chance that we'll probably push lower. The question is, what will the US equity markets deliver? So I look here, right now we're trading 24 points short of the 25,000 level in the Dow Jones. Chances are high that we are making it above that level, even though we are still very, very elevated here. And somehow there's more and more the feeling that rather soon or later there will be a sharper pullback. The question is just, what's the potential trigger here for such a pullback? Remember, around 1 year from now, back we traded around 20,000 points. So we made 5,000 or 25% within 12 months here, and not seeing a corrective move of more than 3% within this period of time. And this is something which you should always keep in mind when looking at this market, even though volatility stays really, really low, meaning that chances that the market will see such a sharp drop here are not that huge right now. So I'm not willing to take anti-cyclical short engagements, even though I'm still considering long engagements to be probably only attractive on an intraday basis and based on, yeah, for example, open range breakout setups, which are given and where you just have the setup and you just trade the setup. Even though I probably do this here and prefer to do this with reduced position size. So don't be too aggressive with long engagements, and probably don't be too or don't set your expectations too high that we'll see 25,000. That was something which was also topic last year. It took nearly 3 weeks to finally push us above that level here. So probably you remember that was here. That was in January. So we are trading, we traded as short as something like 1 point of the 20,000 level, and the final break happened then on the 25th of January. But then there was a huge break here at the beginning of February with a sharp rise in prices. But this is also something you should remember and recall here. So don't see the market trading already above 25,000. So probably we are not making it above that level, and the upcoming days are in fact quite boring, even though, again, chances are probably a little higher than that the market will probably see another push lower, and that volatility probably sees a short spike, the VIX especially, back above 10 here. Yeah, the situation in the equity markets is exciting to watch. Let's see what the FX markets deliver. They're still the same picture on the daily basis here. 119.40, 119.50 is a potential long trigger for long engagements, which are aiming for a break of 21. So far, again, chances are given that such a pullback does not happen if the data disappoints, especially ADP data today, which usually leads or is a good indication for the non-farm payrolls then on tomorrow. Tomorrow they will be published. There's also the ISM non-manufacturing. Interesting enough, the employment component in the manufacturing data set yesterday disappointed. So meaning there's probably already a small hint that the employment situation is not that great, looking that great, and it could indicate a further drop or to a further drop in the US dollar, and then a final push of Euro USD above the highs of 2017. Even though most of this should be priced in, it's no big game changer if the data disappoints. And you should also keep in mind that the US dollar here has seen already huge losses over the last 3 weeks, and is trading around its 2017 yearly low. So all in all, I have to say, well, even if the data disappoints, does not necessarily mean that the US dollar will sharply decline and sell off again. The picture in all the other markets, FX markets in this case, hasn't changed to yesterday already, as already described here in dollar Japanese yen. I consider region around 112 to be really interesting. If we break below that level, there's further room on the downside for at least another 100 pips, which could easily push us towards 110.80, 111, and probably even below that. If especially it is we get to see such a break in combination with a potential risk off in the markets, and equity markets probably also coming lower a little while volatility spikes up. Yeah, while the situation in gold isn't that fascinating right now, so we've seen a first test of these highs here from October around 1,307 USD per ounce. I still consider this region around 290, 295 here to be more interesting for long engagements. The current price action, which is, if you look at the intraday charts here, which is kind of really choppy. So you've seen a quite aggressive drop already in the first hours of trading yesterday. Then a sharp drop here in the evening, 7 p.m. GMT. There was this bigger push, probably indicated because of the FOMC minutes which were published here, which was aggressively bought back again. So it was no real deal of the data which was published there. And then we see another drop in the first hours of trading of this day. Now we push back again. So this choppy price action and this up and down is somehow indicating that here in gold, bulls and bears are right now somehow fighting a little. Some might be skeptical. Those probably bought aggressively gold at this breakout here on the downside and are now seeing some attractive gains in their P&L. That the next numbers, even though they won't change the next data sets which are published from US today and also tomorrow, that they won't surprise on the downside, which would then push gold probably higher if the US dollar keeps on falling. They're probably a little skeptical, while others say, well, every dip should be bought because we are not yet done and gold has further potential on the upside. The current price action is indicating exactly that, even though I have to say I definitely prefer buying gold a little lower, around 290, 295, probably not even there, but probably we have to wait there and, for even a better chance. But all in all, the picture in gold hasn't changed that much. Right now, in fact, my focus is here on WTI, on crude oil, and let me tell you why. So yesterday we've seen another sharp rise here, which pushed us as high as, or in the morning it was, we traded as high as 62 USD per barrel here. By the way, this is an indication of the liquidity providers of JFD brokers, which is working with the current oil contract, and the oil contract of the upcoming month. And it's a combination of both prices. You can find the calculation of the price here on the website from JFD. And the reason for that is because JFD is offering a so-called continuous contract. So you don't need to roll over in the next contract here. And to make sure that this is possible, you have a combination of the prices of the current and the next month future WTI crude oil future. And so don't be too surprised if you see another price somewhere else. That's the reason for this divergency, respectively, for this small difference. But in fact, it doesn't really matter. What we've seen is that we are trading short of the highs here from 2015. And in fact, very, very extended on the upside thanks to this push yesterday. And remember that we know about a very aggressive net long exposure in the commitment of traders report. So speculative forces are heavily net long WTI right now. And such sentiment extremes are likely to probably see a sharper decline in the near term in case of a net long sentiment extreme. Based on a potentially domino effect. So probably one of the main reasons for WTI pushing also aggressively higher, not just here in case of the or in terms of the speculative positioning, but also in terms of price. This is potentially the main reason for that is potentially should be found. Can be found here in the conflict in Iran right now. Probably that's one of the main forces driving prices higher. But again, the market looks really extended on the upside. Plus, we have a sentiment extreme. And remember today at 4 p.m. GMT, we have the crude oil inventories. And I remember one time, in fact, last time we've seen such a huge sentiment extreme, that was last year in March. So you can also see this here in the chart. That was here. So, and we've seen a sharp drop there. I mean, the price action was different, definitely. So the market pushed higher and stabilized it at a quite elevated level, while speculative forces were building long positions in WTI, crude oil futures. And then crude oil inventories came in above expectation and pushed crude oil aggressively lower. And not just one day, but then several days after here. And that's something you should keep in mind. That's just one small piece, which probably is not that relevant, but it's relevant in the moment the market is seeing such a huge sentiment extreme. And so with this in mind, it's probably interesting also from a risk reward perspective here to consider aggressive anti-cyclical short engagement in this region. The only problem you might have is, well, where to place the stop. And this is in fact a good question, and it's difficult to answer, even though I think it's probably worth to consider a volatility stop, which is meaning right now we have an ATR, so average to range, which is at around 80 cents, 87, something like that. So close to $1 per barrel. So if we enter an anti-cyclical short here, with a target, let's say probably around 58, 80, 59, that's a chance of something like $3, and you're working with a $1 volatility stop. So placing the stop somewhere around 80, 62, 80, 63. Well, this could mean that this means that you get a risk reward of a 1 to 3, which is quite attractive. And I think if you combine this with the sentiment extreme, and not really knowing when such an effect will take place, I don't know, we don't even know if it will take place, but there's a good chance that it will, then it's probably worth to just give it a try. Position yourself with a small position short here, placing your stop ATR based or volatility based here around 62, 80, 63, and then aim for the region around 50, 58, 80, 59 here around. It could be quite interesting, and it's definitely worth watching also from a research perspective. And yeah, in fact, that's it from my end. So happy trading. Watch your stops, and talk to you again tomorrow, the morning meeting, 10:30 a.m. GMT. I definitely look forward to it, and that's it from my end. So have a nice day. Keep keep watching your stops. Take care of yourself, and have a nice day. See you, and bye bye.